Okay, so in this part of the video, we're going to be focusing on calculating capital gains tax, right? So here is the triangle that I made mention of in the earlier videos that we always start with that. VAT comes first, unfortunately, whether you like it or not, VAT comes first, then our income tax, which is our normal tax, and then capital gains, right? So, side note, general points show all calculations, even for nil amounts. Like I said, the examiner wants to know why the zero is a zero, right? And even when a gain or loss will be ultimately disregarded. That's also very important. And normally disregarding is those letter paragraphs like your primary residence, your small business assets, so on and so forth. Like from paragraph 44 onwards, that's where you'll find where we disregard a gain or loss or both at the same time. So always show amounts that are basically, I almost said null and void, but they're not. So, because the examiner is more interested in what you know that it shouldn't be there rather than what's supposed to be there. Hence, don't waste time saying we're including this person's salary in gross income because paragraph C of the no. Just say salary included, move on. But the minute there's something that you don't need to include as an amount, you need to state the reason why. So, like I said, we always start with that. So, with that, we consider whether VAT should be removed or not. And that is also guided in the scenario where they state all amounts include or exclude VAT, right? Does the That's the first point actually. Does the given amount include VAT? Do we have a vendor? Is a person a registered VAT vendor or not? And that is very important, right? Because our taxpayer can be a non-vendor, but they bought from a VAT vendor. So obviously the purchase price included VAT, but our taxpayer cannot claim that VAT as input because what they are not a vendor. So they just take it as it is as a cost. And there's nothing to basically ease that cost onto them. So even though that amount does include VAT, you need to remember who your taxpayer is. Are they a vendor? Are they not a vendor? Right? And you always need to know your type, time, and value, and whether there's any apportionment that we need to do. And remember, apportionment always applies for mixed use asset or general use asset, right? So if it's exempt supply, if there's an exempt supply for the specific asset, that's when we use apportionment because that 15% is relating to exempt supply. So there's no need for us to deduct VAT or to add VAT, whereas that VAT was never incurred. Okay, cool. And then the second part is income tax allowances, right? Income tax, we are basically focusing on allowances, and our allowances lead on to our recoupment, right? So you need a timeline. Are all the allowances available? Have they used all the allowances, the current year allowances as well? Are they apportionable allowances or not? And yeah, that's also that. And then since we are selling, there needs to be a recoupment, and the recoupment would also be income tax, but it also goes into capital gains because our recoupment reduces selling price, whereas our scrapping loss reduces, our recoupment, yes, does reduce our proceeds or selling price, whereas our scrap loss reduces our base cost. So you always need to remember that. And the formula for recoupment is the selling price limited to cost less tax value, right? Deferral, something that we can do later, but basically there are times where you're going to defer the recoupment or the capital gain. And yeah, lastly, this is the CGT part, capital gains tax, which is where we reduce the proceeds by the base cost, and proceeds is selling price less recoupment, and base cost is the cost less allowances. So all the allowances at the point of sale until point of sale. So if they had allowances for 5 years and we sell in year 3, so it's gonna be allowance for year 1, 2, and 3, and then the last 2 years will basically go over to the new owner, right? And remember, capital gains is per asset. We don't group our assets. It's always each and every asset. So if we have 10 assets that we're selling, we're gonna focus on each and every asset on its own, even if they are identical. Okay, maybe we can just group them, but what if they're bought at different periods of time? So it's very important that you deal with each asset separately on its own. And remember, annual exclusion is for the normal natural person. Sorry, not for companies. If your examiner says that annual exclusion, I'm sure they will chew your paper up. And then let's assess capital loss, right? Remember, we bring it forward. If there was one in the previous year, current year loss, we carry forward. Or if it's a gain, then we do the inclusion for 40% for individuals and 80% for companies. And that is brought into your normal tax again, which is your income tax per section 26 cap A. Okay, and this is normally how we structure things out. So here's our gross income, exemptions, deductions. Capital allowances is also part of deductions. And then we have our tax value, we have our recoupment. As you can see, we can either add the recoupment because we still have money to our taxable income, or we reduce our taxable income with our scrapping allowance, which is our section 11O deduction. And then we have the taxable capital gain, which is section 26A, and that's how we get it, and that's how we get your taxable income, right? So here's an example for an SPC. SPC has allowances, which is our section 12 cap E, right? Or section 12 cap C, depending on the election, and VAT, So Helios is a small business corporation, SPC, per section 12E of the Income Tax Act. Category B, VAT vendor, and that is important to determine when do we pay VAT over. So this is an even month VAT vendor, invoice basis, and make 75% taxable supplies. So that is for apportionment purposes, and all suppliers are VAT vendors. So chances are every amount has VAT. So you can claim, or you can provide, or you can levy output VAT, unless specifically stated otherwise. So unless they say this vendor is not, this supplier is not a VAT vendor, then you know that the amount does not include VAT because they cannot levy VAT, right? Relevant and valid documentation obtained, all amounts include VAT. So we have to account for that. And 1st of November, so important way in the year end we are in, and purchased new specialized equipment for 86,250, used to local clients only and brought into use. So remember, in tax we care about when was something brought into use, right? So for you to be able to claim allowances, we need to look at the date in which this asset was brought into use. Whereas for financial accounting, it's available for use. So the minute an asset becomes available for use, even if it's not going to be used at that point in time, as long as it's available, you can use it because it's available. That's when you start depreciating that asset. So it's important for you to know that in tax and accounting, those dates matter. So chances are this asset was available for use, for example, maybe on the 1st of October, which is a month. So depreciation started on the 1st of October, whereas allowances were deducted on the 1st of November because that's when it was put into use in the business. But on the 1st of October, it was available for use. Okay, just thought to highlight that. On the 24th of February, Helios sold the equipment for 63,000 to an unconnected third parties, right? So we don't know whether this third party is a vendor or not, but it doesn't really matter for us because either way, we have levied VAT. Okay. And the lease entered into Helios is 2025 year of assessment, wara. But basically, this was what was done, right? So we determined the allowances that Helios got for the asset, and obviously we can't recognize the proceeds received for the asset because it is capital in nature. and that's the recoupment, and that's the taxable capital gain. And it was nil, right? Because the proceeds and the base cost basically were equal. As you can see, we deducted the 40,000 recoupment as well as we deducted the total allowances, right? So current year will reduce current taxable income, but when we aggregate everything, it gives us the total capital allowances that we were able to deduct in all those years as 60,000. Okay, and that is a wrap. See you in the next video.